All right. Well, thank you to PCOB and the PCOB staff for having us today. My name is Anthony Vinci. I'm here with Mark Ramler. We both work with FINRA in the Office of Financial and Operational Risk Policy. Our group, or our role at FINRA, it's a small group, probably best described as subject matter experts within the group on the financial responsibility rules. We spend a lot of our time on policy guidance, internally and externally on SEC and FINRA financial responsibility rules, and kind of the underlying US GAAP implications of some of the rules as well. In general, the way FINRA is structured, you may hear us refer to the firm. I'll try to correct myself. We'll try to correct ourselves, but when we say the firm, we're likely referring to the broker-dealer. We're usually not referring to the auditor. So if we say the firm, you can just assume that. But in general, broker-dealers, each broker-dealer has a risk monitoring analyst that is assigned to them. The risk monitoring part of our organization sits under member supervision. Member supervision has a number of different areas. Also includes the examination arm. We do cause exams, fraud exams. We also have areas around market regulation, which is frankly not an area that we work closely with. We're really more on monitoring the firms themselves, not the reps, and not really the market activity in terms of just the financial solvency, customer protection, books and records, things of that nature. We do obviously have an enforcement arm, and our group actually sits in the Office of General Counsel or the Office of the Chief Legal Officer. We're probably the only lawyers not in that office, actually. So we're mostly CPAs, former examiners, or career regulators, but a good mix of people in the group. So as we go through this, I definitely encourage to ask any questions that you might have. I will say that anything that's like super facts and circumstances specific, it'd be a challenge, obviously, to address it in a forum like this. But if you're in the room and you have a very specific question, feel free to grab one of us after the session. We're happy to have that conversation with you. Or if you want to reach out to us separately, you can do that as well. So in terms of agenda, we'll hit on some hot topics. Recent regulatory guidance, so we'll tee that up with recent reg notices, or at least the ones that are relevant, I think, to this group. Risk monitoring and exam observations. So many of you might be aware that every year, at least for the last few years, every year FINRA has put out, they've rebranded it every year, I feel like, but I think last it was referred to as like a priorities report, where they outline some best practices of things they've seen at firms, considerations, and common exam findings or trends. So we'll go through a little bit of that. I mean, obviously everybody here could read, so we're not going to just regurgitate what's in the report, but we may highlight some items, and we'll try to give you some color around some things that you may not necessarily find in the report. We'll talk about exemption reports. I know that's always kind of a hot topic, so Mark will go through that a bit. And then at the end, I think these slides were circulated to everybody. We have some links to FAQs and key hot topics that might be helpful. And most importantly, the CPE code is 238. 238. All right, so hot topics. So I'll walk everybody through the first couple of topics here. One of them being the SEC, the daily 15C33 computation proposal. So currently as it stands, and obviously this would really apply mostly to your clearing and carrying firms. Actually, before we even get into this, for those in the room, how many of you, I'm assuming almost all of you are auditors, but who actually audits broker-dealers specifically? Just by show of hands. Okay. So most of the group in the room. Okay, thank you. One of the previous forums, it was kind of a mix, so I just want to make sure we're addressing kind of the right topics here. So the daily 15C33 computation proposal, obviously it's a proposal put forth by the SEC. Currently, firms that are actually subject to 15C33 and have to do a customer reserve computation, that is done for the most part on a weekly basis. There are some smaller firms that do it monthly, but on the whole, it's a weekly computation. And this proposal would make it daily. Now, that was put out, I think it was kind of like the middle of 2023, and the comment period ended a little over a year ago. It would apply to carrying firms that with an average total credits greater than $250 million. And in terms of impact, it impacts probably about 60 firms, 60. Just for context, we have probably a little less than 3,400 registered broker-dealers. So 60 is obviously not a large portion of those firms. But 11 of the 60 already voluntarily do those comps on a daily basis. So they've already kind of put that into practice and put it into their policies. And just for context, it's probably like 150 firms that do a computation in general. So there are also a number of firms, a little bit more than half, that would not be subject to this based on kind of that credit threshold. There would be some lead time to implementing this. Why go daily? I think it's something that's frankly been a long time coming. I think the main hold up on it over time has been, especially for like your medium or small size clearing carrying firms, having the staffing and the technology to be able to do this, right? For those that, you observe your clients doing the 3-3 comp on a weekly basis, that's all they do on Mondays, right? It takes up a significant amount of time. They may have one person that is just hired to do just that. But we've seen a lot of strides in the industry in terms of automating a lot of this in the background. And obviously the SEC is of the view that it's the right time to roll it out. There also, I think a lot of this comes from SIPC as well. They were a big proponent of wanting to see something happen here, and I think the big reason is that it mitigates the risk of net cash owed at a point in time to customers being greater than what's actually on deposit at a point in time in a special reserve account, right? So you could have a very different liquidity risk or customer protection profile a week out from when you do a lockup. And by doing it daily, it kind of shortens that. It shortens that liquidity risk a little bit. There could be a mismatch of reserving for customers versus the speed of the markets, obviously, depending on your collateral base. We imagine there's obviously going to be a cost to implementation here in terms of staff and technology, but I think this is something that firms are starting to get ready for now. In terms of timing, I guess elephant in the room, with the election just ending and kind of being a transition, this could change, right? But I think if you were to ask this question a few months ago, I would tell you it seems like this is likely to get finalized by the end of the year as a final rule, and then there'd be an implementation period on top of that. So likely wouldn't be like a next year event. But I think at this point in time, I think like everyone else, we're kind of waiting and seeing, and what's the SEC going to do, and how fast will this get rolled out? Will there be more time to implement? Will it go away altogether? I have my own personal views on that. I could share that separately, but that's kind of where we are, I think, on that right now. The other thing to keep in mind for those of you that maybe have clients that would have to implement this process is thinking about the compliance report and internal controls over compliance. What happens if you have to do, whatever it is, 270 calculations or something less than that a year, and you miss one? What does that mean, right? Like something doesn't batch over overnight, or there's some system issue. And I think the answer to that is it depends, right? It depends on, is it really an issue in internal controls over compliance? You certainly would have to consider material weakness, but is it really material weakness? So those are things to think about, I think, from an audit perspective as well, as you think ahead to, kind of having to audit this process. Next item we have is the SEC electronic filing proposal. So This was a proposal that was issued March of 2023. Comment period ended in May of 23, and it's been relatively quiet since then. Just to kind of tick down some of the highlights on this, because it's not just broker-dealer related, but it touches on a lot of broker-dealer type items. All annual reports, and for your firms, for your broker-dealer client firms, the Form 17H, for those that have to file it, would be required to be filed via Edgar, so there'd be no more paper filings if this rule went into effect. There would be an XBRL requirement, so for those that have public company clients, you're familiar with that. This would be required of broker-dealers as well. I know there's been some talk of, hey, well, that seems, for smaller broker-dealers, that seems like a lot, or do we think that's going to change? I have no idea. I would imagine some of the discussions would be around, hey, maybe give smaller firms more time for implementation on it than the larger firms. I think that's kind of a natural discussion that happens for these types of things when there might be a divergence between small, medium, and large firms. But I think that's, as it stands, the proposed rule right now, so it's not actually a final rule, but the proposed rule would require that in terms of a detailed tagging requirement. There would be some revisions to the focus report, mostly technical changes and clarifications, so some revisions or some corrections for where some of the signatures would go. You would be able to file electronically. I think that was unclear before, whether you had to actually maintain a focus with like a manual signature on it. So this rule would make that clear, that it could be an electronic signature. There'll be some minor adjustments, I think, to the income statement, and things that are commodities or CFTC related, you'll see some items get tweaked as well. But I think the substance on the whole would stay the same for the focus report. Again, if you were to ask earlier in the year when you thought this would go into effect, I would have said, the rule will probably be finalized by the end of this year. At this stage, I really don't know when it will be finalized. So we'll see how that goes. But the one thing I can say about the electronic filing proposal and the daily 3-3 proposals is that the commission voted on each of them unanimously, approving them 5-0, so across party lines. So that's just something to keep in mind as we go forward. I'll hand it over to Mark. He'll walk us through SAB 121 and revenue recognition.
Okay, so Staff Accounting Bulletin 121 was released by the Office of the Chief Accountant back in 2022. Sorry, let me lower this a little. Oh. And it covers accounting for safeguarding of crypto assets held for platform users or for customers. Custody of crypto assets, in other words. And this surprised many, but the OCA also advised that this SAB applies to broker-dealers as well. And the OCA does have accounting oversight over broker-dealers, but this is probably the first staff accounting bulletin that they have ever advised that it applied to a broker-dealer, because as you know, most of those staff accounting bulletins are really to enhance reporting to investors and shareholders. And the reason they issued this bulletin was they were concerned about the unique risks of crypto assets. And those unique risks include the custody of crypto assets. And therefore, they wanted users of the financial statements of the crypto custodians to basically have enhanced greater information regarding those risks. And what the accounting requires is for a firm, crypto entity, to recognize a safeguarding obligation on its balance sheet. This is not disclosure. This is on its balance sheet, and a corresponding asset, whatever you want to call that asset. And this is obviously very different from broker-dealers under ASC 940, because if a broker-dealer holds customer securities, those do not get recorded on the balance sheet. And what was very interesting was the SAB also requires agents of the crypto entity to recognize the safeguarding obligation and the asset. So that means if a broker-dealer shared a platform with a crypto affiliate or a third-party crypto entity, that firm would have to gross up its balance sheet. So this kind of swept in a whole bunch of FINRA member firms, and those member firms had to record the safeguarding liability and the corresponding asset. And the SEC Division of Trading and Markets advised that they knew of no basis to treat the asset as allowable for net capital or to add back the safeguarding liability to net capital. And therefore, many of our member firms had to take significant charges against their net capital. Now, the industry was quite concerned about this. The AICPA stock brokerage expert panel sort of took the lead in dealing with the OCA on this. And in February of 2024, February this year, a group of the expert panel members met with the OCA. And the OCA outlined a fact pattern that if a firm follows this fact pattern, they would not object if the firm does not recognize the safeguarding obligation and the corresponding asset. So, and if you want to, that fact pattern is really more or less, the firm would have to disassociate itself from the crypto entity operationally and legally. But it's very detailed. It's on the AICPA expert panel minutes from February of this year, if you want to read it. So when the SEC Division of Trading and Markets learned of this, they realized it's going to take a bit of time for firms to be able to change their operating model. So what DTM decided to do is to provide temporary relief. And what that relief is if a broker-dealer is making progress to changing its business model, that firm can treat the asset, whatever it is, as allowable, and the safeguarding liability can be excluded from aggregate indebtedness. As far as FINRA is concerned, we have no view on the accounting as to whether a firm should apply SAB 121 or not. And we leave that up to the firm and their auditors.
Yeah, we've seen a number of firms that have consulted with the SEC's Office of the Chief Accountant on the topic, with varying responses, frankly. So,
any questions? Out of curiosity, anyone have a audit client that was subject to SAB 121? Guess not.
lucky you guys.
Yeah, okay.
All right.
All right, well, this one may be more applicable. So revenue recognition. So FINRA exam continues to see firms misapplying ASC 606 accounting for revenue from customer contracts. And primarily it's in the area of M&A transactions, whereby firms are recognizing the revenue upfront when the retainer fee is billed or collected without considering whether the firm has satisfied the performance obligation or whether the revenue should be deferred. And the reason exam and FINRA is concerned about this is because it overstates net worth and it overstates net capital. And when we ask the firm for any type of accounting policy or accounting analysis, they don't really have any of that information. And when you ask the firm, like, what was your basis? Typical answer would be, well, that's the way I was always accounting for it. So these firms were really not aware of the change to ASC 606. We also, looked at some of the annual reports, and some of the annual reports did have adequate disclosure of accounting policy and revenue streams, but the firms were not following the policies they outlined in their financial statements. And then we saw other annual reports where firms just did not have adequate disclosure. So, exam is going to continue to look at this area if they believe it will impact net capital. Our exam staff is not looking at revenue recognition if they don't think it's going to impact net capital. They're not looking at, let's say principal versus agent, where you're netting down your income statement or something like that. But anything that impacts net capital, you should really think about.
Yeah, absolutely. Okay. So the next CPE code is 616. So just quickly, as we give everyone an opportunity to get that into the app, we had a question about how we are organized, if we are organized under the SEC. So just as a high level, so we're not a government agency. We're structured as a nonprofit and a self-regulatory organization, very similar to the PCAOB. That mandate does come from Congress. We are overseen by the SEC, and we're funded by broker-dealer firms. So just as a kind of a high level there. So we do operate separately from the SEC, but they do have oversight over us. And obviously we work very closely with the SEC as well, since a large part of the rule set, especially from our perspective, are SEC rules over the broker-dealers. Okay, so Mark will kick us off on some recent regulatory guidance.
So I think it was, yes, November 5th, we issued an information notice of all the due dates for the annual audit, focus reports, and corresponding schedules for 2025 and the first quarter of 2026. That is up on our website. We also issued regulatory notice 2302, and that's regarding amendments to the customer statement rule 2231. Now, firms who file a compliance report and their auditors issue an examination report should be aware of this. So these amendments were effective January 1 this year. And previously, there were two customer statement rules. There was 409T. That was the New York Stock Exchange rule. Members of the New York Stock Exchange had to follow that rule. But if you were formally a member of the New York Stock Exchange and now you're a member of FINRA, you would continue to follow that rule. Plus, you would be following 2231. So if you were a former New York Stock Exchange member firm, current FINRA firm, that firm had to follow both 2231 and 409T. So when they merge the two rules together, that would really have no impact for that firm from a compliance standpoint. However, if you were not formally a New York Stock Exchange member firm having to follow 409T, you are now have to follow a revised 2231. And that has other elements in there. Things like, third parties who can get customer statements, logos, what did I forget? All the other ones, below the line investments, things like that. So it's something to look at, I would say, for compliance and for examination this year.
Yeah. And that's in effect from the beginning of this year. So as of January 1, 2024 onward, that would be in effect. So for firms that you may be auditing that are doing compliance report, that's going to be that's going to be very important going back to the beginning of the year. So I think we covered the next item, right, in terms of 2321.
Well, I wanted to give you a chance to say something about it since I sort of did the presentation, but you wrote it.
So for 2321, revenue recognition practices. So I feel like when this first came out, it was like, well, why is FINRA putting anything out on accounting, right? Like, stay in your lane. But like Mark had mentioned, it has depending on the size of the firm, it could have a significant impact on your net capital position. Frankly, we were seeing this issue mostly in our smallest firms, M&A advisory type firms, where they had, and many of you might be familiar with this, had fee arrangements where there's a success fee upon closing the deal, but there's some sort of retainer fee structure either upfront or over time. And the issue was in the accounting for the retainer fees. So I guess the simplest example would be for revenue recognition of the retainer fee. An engagement letter gets signed today, and upon signing, $1 million retainer is paid to the broker-dealer. Presumably the broker-dealer has not provided any service before they signed or to that point. and firms saying, well, the agreement says it's non-refundable retainer. Because it's non-refundable, this is revenue as soon as we collected it, and that's it. And when we started asking about, well, did you consider ASC 606 and go through the 5-step process, we got varying responses, including what's ASC 606. Also, in terms of, well, my legal agreement says I don't need to pay it back, so why wouldn't it be revenue? What are the 5 steps? There were varying responses to it, frankly. So we felt like, and it really was a trend, right? Like this was something that, we were fielding questions in our group for a while on a repetitive nature. And it frankly wasn't even something we were really looking for at the outset. So just felt like it just made sense to kind of give a heads up to the industry, like, hey, this exists, you want to consider this. And it's not like, hey, the firm says, oh, well, we should account for it this way, and FINRA says we should account for it this other way, and because it's different, you need to do the FINRA method. No, actually, I can tell you for a fact that there have been a number of arguments or interpretations that have come to us, and I haven't loved it, but it has been at least rooted in analysis of the ASC 606 standard and has been audited. So at that point, it's okay, well, we don't love it, but we get it, it makes sense, there's documentation, there's analysis. So that's really the key to this, is documentation and analysis, right? Like, if you get all the way, you strip all the noise away and you get really to the core of it, you have journal entries, and you need to have support for your journal entries, right? So what's the documentation for your journal entries? And if it's because of a cash basis accounting methodology, that's going to throw up a red flag, right? So I think that at its core is kind of like where this was emanating from. Was that good? Okay,
that's good.
Just make sure. So the next reg notice 2311, liquidity risk management rule. So I get the sense there aren't a lot of auditors in the room that are auditing clearing firms, but I do think we have a bunch of people on the webinar or online virtually, so I will touch on it briefly. So big picture, liquidity risk management rule, it's something FINRA does not have in its rule book right now. I would start with what is liquidity. So a lot of folks say, well, there's a net capital rule that exists, isn't that liquidity? Well, the way I would explain it to you is net capital, when it was put in place and implemented, was for the purpose of making sure that the firm, in a liquidation, meaning you're already liquidating, you're not actually a going concern, right? You're liquidating, would have enough liquid assets to satisfy any liabilities to counterparties or customers, right? So, but you're in a wind down, whether it's forced or voluntary, whatever it is. Whereas I view liquidity as you want to keep the lights on so you can do business tomorrow, right? Having enough cash or having enough liquid collateral to keep your business running. So this has been a focus of FINRA's for a while. It goes back, frankly, you can probably trace it back, our interest in it back 25 years. But I would say, back during the financial crisis, this was something that we were monitoring very closely as it was impacting firms on a live basis. Back in 2015, we put a reg notice out, 1533. That was kind of a study of firms and their liquidity risk management practices. And if you look at our priorities report for the last few years, liquidity risk management is one of our main financial management topics or areas that we look at from an examination perspective. So even though we don't have a rule on it, we pay a lot of attention to this area. So what I will say is, on the whole, firms do a decent job with liquidity risk management. Obviously, depends on the complexity of the firm. But as you can imagine, there are firms that do not do as well. And given that there is not a rule on the books, it's something that we feel like after all the guidance has been given and the attention that's been given over time, it's probably the right time to kind of put this in place, right? So fast forward to about a year ago, we went out with a concept release to the industry to solicit comment. We went out with what we would propose as a concept of a rule. We got a number of comment letters, mostly from some of the major industry groups. We spent a lot of time speaking to the industry groups, firms individually, and really considering those comments and implementing those and kind of tweaking what our proposal was. Fast forward to now, the plan is to get another regulatory notice out with an actual proposed rule that incorporates all the comments that we've gotten. I would have loved for it to be a holiday gift for this year, and I think we're still striving for that, but it's more likely to be a Q1 2025 event, to be honest with you. And that would be to solicit further comment from the industry. Once that goes out, we get comment, we bring that back, we make some revisions. We would go to our FINRA board. We have a board of governors. We would go to the board to get approval to file, to get essentially permission to file a new rule with the SEC. So I mentioned earlier, we're overseen by the SEC. They have to approve all the rules that we put forth. So we would be looking for our board to approve us to do that. We would file that with the SEC. That's all public. And once that gets filed with the SEC, there's another opportunity for comment. So that's kind of where we stand right now in terms of liquidity. What do we have next? So for the next few, so the theme for the next few is margin and T+1. So I'll keep these very brief. So T+1 obviously was the hot topic back in May in terms of transitioning from T+2 to T+1. Transition went relatively well, to be honest with you. I think there were all kinds of plans for weekend meetings and what would go wrong and things like that, and there were a lot of meetings that got canceled, which was a good thing. So really we saw that it got implemented in a relatively smooth manner. So there really isn't much to say there, but some of the reg notices that we have listed here, they touch on T+1 and some of the rule changes compared to that. So maybe the rule said T+2, right? We had to change it to T+1. And things that might be interrelated there. And then anything related to like transaction reporting, trade reporting, obviously that's going to be based on kind of the settlement cycle of the product. Covered agency, transaction margin, Rule 4210, this was something that's been in the works for a long time, and that went into effect back in May as well. There are some pretty robust FAQs on our website and guidance related to that topic. The one thing I would say just for, I know that, the majority of the folks here and even online, many of you may audit introducing brokers. If you have a broker that is doing business with someone that is doing these covered agency type transactions, so transactions like TBAs, specified pool transactions, CMOs, if you're part of the margin collection process as the introducing broker, I would look very closely on the contractual arrangements around that, because that could have implications on whether you file an exemption report or a compliance report. It's not automatic that you would be a compliance report filer, but it's something to look at very closely. It gets a little bit nuanced. And I think it's touched on a bit in this FAQs as well. So that's something to look out for. Yeah, I knew we'd have another code. So code 417. 417. So Mark's going to walk us through some resources and some considerations around exemption reports, which I think likely anyone that's auditing a broker-dealer has to deal with.
So I think I'd like to, does that work? Good. So I think I'd like to start with just talking about exemption reports and some of the misstate. You're not hearing me?
No, right? Want to hold this?
I don't want to hold it.
There you go.
Sing a song. Can you hear me? No.
Might have to turn. There you go. You're good. Everything you said was brilliant, by the way.
I know.
You have to take my word for it.
Well, it's an exemption report. No one understands what I'm talking about anyway. Every time my old firm, I used to give these hour presentations on exemption reports. It was like I was speaking another language. So hopefully that will not be the case now. But we still see misstatements in exemption reports. So I wanted to go over some key concepts and considerations, right? So the exemption report covers all business activities of the firm and how it operated for the year. Remember, it's just an annual report. And you have two different types of activities. You have the covered activities and you have non-covered activities. So covered activities would be those activities covered under 15C33 paragraph K. Paragraph K exempts firms from having to prepare a reserve formula or considering possession or control for customer securities. And there are three different categories of paragraph K, and firms still get these incorrect, right? So you have K1. K1 is exclusive for firms that only sell mutual funds and variable annuities. That's all the firm can do as far as securities business. If they want to sell pizza too, that's okay. But any other securities activities, they would not be eligible to claim they operated under K1. And we see firms that sell mutual funds, variable annuities, but they're also duly registered as an investment advisor. And if they're duly registered as an investment advisor, if the investment advisor business is taking place in the broker-dealer, that's considered to be part of the business of the broker-dealer. And therefore, those firms cannot claim K1. They will most likely fall under footnote 74, which we'll cover shortly. So the next category would be K2I. And again, K2I is a very limited category. K2I covers firms that self-clear, carry no margin accounts, and settle all transactions through an account for exclusive benefit for customers. And those are generally going to be your DVP, RVP transactions, or firms who chaperone foreign brokers under 15A6. And we see firms claim that they operate under K2I, but they're not operating under K2I. And some of that's caused by the fact that these firms have a membership agreement from 15 years ago that says, the firm's approved, to operate under K2I. But it's very limited to just the DVP firms and generally the 15A6 firms. And then we have, the K2II firms who clear on a fully disclosed basis. We don't see any misstatements there. But under paragraph K, firms are supposed to state that they operated under paragraph K without exception or with the following exceptions. And they list the exceptions. Most of those exceptions are going to be prompt transmittal of customer checks, generally. And where you don't promptly transmit within the required timeframes, it's an exception. But there could be other exceptions. Let's say a firm inadvertently received customer funds. That could be an exception, and that should get reported too. And we had a question at another forum we were at, and the question was, does the fact that a firm has a lot of exceptions under paragraph K mean that that firm should be fully reporting firm, meaning reserve formula, they're not in compliance with paragraph K? And the answer is no. I mean, we'd have to look at the facts and circumstances, but if all you're doing is promptly transmitting customer checks, you're not carrying customer accounts. You're not a true carrying firm. If we see firms that are inefficient or ineffective in promptly transmitting, we ask them to improve their processes. So now we get to the non-covered activities. Non-covered activities are all the other activities that a firm does. Proprietary trading, repo, stock loan, stock borrow, conduit book, M&A, direct mutual fund, and variable annuity business. And all those activities that the firm operated during the year should be identified in the exemption report. And then the firm has to make a little different of a statement than what they do under K. They have to state that they did not hold customer funds or securities during the year. So that's the key thing with footnote, what's called footnote 74. Now, footnote 74 came out with the 2013 amendments to 17A5, basically. And footnote 74 covers all these other activities. You might have activities where you're required to promptly transmit, and that would be fine. So for direct mutual fund business or for contingent, equity offerings or something like that. But if a firm holds customer funds or securities, they cannot claim they operated under footnote 74. If they do receive customer funds and it's inadvertent, meaning an accident, that could be treated as an exception, and they could list that as an exception. But if it's how the firm operates, the firm will not be able to claim they operated under footnote 74, and under 17A5, that firm will likely have to file a compliance report. Now, let me give you an example. So let's say you have a firm that clears on a fully disclosed basis, and that firm gets rebates from various trading venues, and they receive them directly. They turn around and pay them directly to their customers. That firm would be considered to be holding customer funds, and that firm would be required to file a compliance report. And you also have to think that 17A5 and 15C33 are two different rules that have to be complied with, right? And in that previous situation, if the firm set up an account for the exclusive benefit of customers and all the rebates from the various venues were deposited into that 3.3 K2I-like account where customers were protected, and then the firm affected all, payments out of that account, that firm would be in compliance with paragraph K. However, because they held customer funds, they would be required to file a compliance report.
As you can imagine, there's a lot of different variations when it comes to the exemption reports, for sure. Just in respect of the time, I think we have a minute left. We did have a few questions that came through, so I can, if I could steal an extra minute, I'll just kind of go rapid fire on some of them. And I'll go backwards because there's a couple that are related to exemption reports. So can you clarify that an exemption report may state that operating under paragraph K as well as paragraph 74, it used to be communicated you only claim footnote 74 if none of the others applied. So what I think this is referring to is if you are relying on footnote 74 to file an exemption report, can you also have a business line that is exempt? So can you have kind of like a hybrid exemption report where you're introducing part of your business under K2II, but you're also doing prop trading, which would be footnote 74. Short answer to that is yes, you can do that. That's something that we do expect. One thing that might be helpful for those not as familiar, the AICPA has an exemption report templates out there. It's not our guidance, but to be transparent, we did look at them before they were published, didn't object to what was outlined in them. And we have found that it's kind of streamlined a lot of the reports that we've gotten come in. And we definitely have a higher compliance rate in terms of how the report is actually coming through. One of the other questions was related to footnote 78. I think we're going to have to leave that one for another session, frankly, because I think that footnote 78, if you did want to read up on that a little bit, we have an FAQ on the screen. I believe it's the first FAQ, and if under number 8, it talks about footnote 78, and that you can request release from the SEC there. So, in terms of observations, honestly, we've kind of weaved some of that into what we've gone through so far, I think. What I would say is that 95% of our firms file exemption reports, and 70% of them are retail firms. And really the biggest exception we see is prompt transmittal of checks or funds. I think that's kind of the bottom line. Wanted to make sure you got your CPE codes. There was none in between these. Here's the listing FAQs and key topic pages. These are all linked up, so you should be able to see everything there. There's your CPE code, 375. Any questions that we didn't get to, you could feel free to email myself or Mark. We're happy to talk them through with you and address them. Those that are here in the room, we're happy to discuss them as well. But otherwise, I think that's it.